Ymedia.
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 Stay tuned with Ymedia.
Ymedia is a media company. With 360-degree approach in reaching the audience over 8 media platforms.
Hello and welcome back to Ymedia Newsroom. I'm Ramona Singh, and we are talking about the trade war Canada is in with the United States. And since that collapse of the negotiations that were taking place and the 50% tariffs that have been added on Canadian goods, totaling about $28 billion worth of Canadian goods, well, immediately you have U.S. steel stock, and steel is one of the items that have the 50% tariff. The U.S. steel stock rose following Trump's announcement. So Steel Dynamics gained as much as 6.6%. Nucor gained as much as 5.1%. When it comes to shares of Canada's Algoma Steels, well, it declined approximately 8.2%. So you can see that the markets are reacting quite immediately on this failed talks, this collapse of negotiations between the two countries, and essentially now the onset of the 50% tariffs and what this means for Canadian jobs in those sectors and what is going to take place in the retaliation that Canada is going to add on when it comes to a response to the US in terms of their tariffs. And now the latest headline that's going around is that Ottawa is reportedly expecting the US trade talks to remain frozen until after the US midterm elections. Now, the Canadian officials are reportedly believing that there's going to be no negotiations with Washington in that short period of time. The midterm elections are just around the corner, and when school starts after Labor Day, then we're looking at September, October, then we're into full-on midterms elections, and therefore the negotiators in Ottawa believe that these talks have collapsed over heavy tariff relief, heavy trucks, Canadian trade, independence, and cultural policy. And so Ottawa is not expecting any meaningful negotiations before the elections, the midterm elections, and therefore it's going to schedule what could change if the economics or the political pressure intensifies. But this is very significant because you have this is a big test for Prime Minister Mark Carney, who essentially became a politician in this time of trade uncertainty with President Trump's second administration, second term, and in that administration imposing tariffs and, trying to get rid of Kuzma and really derailing talks and this 50% tariff. And so this is a time where we saw the polls, how majority of Canadians didn't want Ottawa to give more concessions. But this is also a time where Prime Minister Mark Carney has to show what's happening in Canada in high inflation numbers. Then there is the unemployment numbers, and now these negotiations and 50% tariff is going to definitely impact, as the latest numbers is 90,000 Canadian jobs. And then if he imposes retaliatory tariffs, then that's going to affect more jobs because then simply it is what it is in terms of being able to do business with the United States. Now, him not doing any of those things and making concessions is also not going to be great for his position, because Canadians want to have Ottawa stand firm against the president. And really the sour taste that the president's put in Canadians' mouths when it comes to talking about Canada being the 51st state and calling the prime minister governor, and this was back at Justin Trudeau's time. So since then, a lot of things have really derailed the relationship on from Canadians' perspective, and if anything, it's driven more of a buy Canada approach. And it appears that this is just another way of pushing a more buy Canada approach to have Canadian producers and Canadian consumers. And so to that, you have RBC Economics. The Economist has suggested that, and RBC, the bank, economists have suggested that Canada could design a retaliatory tariffs to encourage domestic buyers to replace targeted American imports with comparable Canadian products that would otherwise have been exported to the United States. So saying that because Canada imports more of the affected goods from the US than it exports south, then domestic substitutions could theoretically absorb a large portion of lost American sales. This is according to the economist of RBC, the bank. Now, Canada does import more targeted goods from the United States than it exports. So that's part of the concept of having these retaliatory tariffs that could make American products more expensive, right? So these retaliatory tariffs are going to add a tariff on American goods that get imported to Canada, which then the average Canadian just will not buy. So if there are Canadian products instead to purchase to replace those American products, then this is what RBC is suggesting, saying that Canadian buyers could redirect their purchase towards a domestic manufacturer. And that's become a thing. Like if you see Made in Canada logo, then you're more likely to now opt for it, given if the price points are well. But this is part of the discussion here, saying that even if Canadian products are a little bit more expensive because it's made in Canada, because of labor costs and whatnot, having tariffs on American goods will of course make probably the Canadian made products perhaps more affordable at par, but then a Canadian's more likely to lean towards Canada made. So that is part of what RBC has announced. And this is to see what is going to be part of that list. We don't know yet from Ottawa, but we will know prior to the date, hopefully, but definitely on the announcement date of September the 8th. Unifor has also reached a new collective agreement with General Motors covering approximately 4,600 Canadian workers. Now, Unifor is a union. They say that the agreement follows the pattern established in the contract with Ford last month. And so negotiations with Stellantis are also scheduled to begin next month. This is very, very important because approximately 4,600 GM workers are represented by Unifor, the union, and the agreement is aligned with Unifor's Ford settlement. So now the Ford negotiations could negotiations concluded last month, and the Stellantis negotiations are to begin next month. Note now, ratification details were not included in the newsletter that was sent out by Unifor, but Unifor has typically selected one of the Detroit's 3 automakers to establish a bargaining pattern that then it seeks to apply across the industry in general. So now the key issues are wages, and this is about the union Unifor. So now we're not talking about the politics on Trump and Carney anymore. So the key issues generally include wages, pensions, job security, investments, commitments, and transition to electric vehicle production. And so this is very important because the contract provides short-term labor stability. But when it comes to the US automotive tariffs, it also creates a larger threat that collective bargaining cannot really solve, right? So when you have tariffs on auto parts, then, even though you're doing the trade negotiations with Ford and GM and Unifor, but to be able to establish job security and commitments. But of course, if the Canadian plants can remain competitive within what we currently have right now is an integrated North American automotive industry. So it'll be very interesting to see what is going to take place when it comes to these tariffs and how it's going to affect this industry and what it means for jobs and if Unifor is actually taking that into consideration and if that is part of the negotiations. Now, Canada also waits as possible of what could take place on the numbers for the GDP report before what would be a tariff damage. So now Friday, that is August 28th, the GDP report is expected to confirm stronger than anticipated Canadian economic growth during the second quarter. Exports and increased automotive production help drive the rebound, but both sources of growth are, of course, being threatened by the higher US tariffs. So now the report may therefore capture economic conditions that no longer exist since these 50% tariffs have now gone into effect. Now, this is very important because we're going to be covering Canada's Q2 GDP numbers that will be released this Friday, August 28th. And Q2 growth is expected to be stronger than the previous months. Of course, we saw parts of Q1 as a contracted economy with the GDP numbers decreasing, and therefore it meant that Canada was in a technical recession. And then we saw the rebound. So the Q2 numbers are going to be very important, but it also means it's not going to be reflective of what's going to take place in Q4 because of these tariffs. Now, major contributions to the Q2 numbers will be stronger exports, increased automotive production, as well as new U.S. tariffs that, is going to change things for the next quarters. But economists are expecting a stronger headwinds than Q1. So that's going to be very important to take a look at and what it means for potentially positive GDP numbers. So that is what we're going to, of course, cover in quite detail on Friday. Now, over into the US, while bankers are gathering for the Jackson Hole Economic Policy Symposium, where investors will look to Reserve Chair Kevin Warsh for guidance on persistent inflation numbers in the United States and what is seen as turbulence in the US bond market. Now, Treasury yields have continued climbing despite debt buybacks that are conducted by the Treasury Secretary Scott Bessent. So there's that thing with what is the Treasury doing and what is the Federal Reserve doing, and it seems like it's contradictory. And this is what this symposium is going to address, because when it comes to this annual meeting at Jackson Hole, it's led by meeting central bankers and economists. And as inflation remains stubbornly elevated and you have US Treasury yields that continue to rise, you have Treasury Secretary Scott Bessent that has been buying back government debt, and the buybacks have not yet produced a sustained decline in the yields. So when it comes to bond yields, they affect mortgage rates, corporate borrowing, government debt service costs, as well as equity valuation. So when the Federal Reserve controls short-term monetary policy, but does not directly determine what would happen in the long term when it comes to Treasury yields. So now this is up to Kevin Warsh to essentially assure the markets, without promising any level of outcome when it comes to the Federal Reserve, that it essentially cannot guarantee. So when it comes to higher long-term yields, it may reflect inflation, higher borrowing costs, fiscal borrowing, and investment risks, of course, but this expectations for, it's also going to set expectations of what could be the case when it comes to the Fed's next interest rate decision. And when it comes to international news, well, the United States has launched what they call the economic D-Day against Iran. President Trump's administration has expanded Iran war into a global economic confrontation. We know that this war began on February 28th. It was with Israel, United States, and Iran. And as the conflict escalated, we saw Iran closed off the Strait of Hormuz that controls 20% of the world's oil supply, and really kicked everything into gear when it comes to high gas prices and our inflation numbers going up because of the energy costs, then contribute to higher transportation costs, and then higher fuel and food costs. So now, nearly almost 6 months into the conflict, that has now failed to secure Washington's objectives. So you have President Trump's administration, who's now shifting what they call the from escalation point in the Strait of Hormuz, or with Iran when it comes to exchanging missiles. But now what they're looking at is an economic D-Day, which is supposed to attempt to isolate Iran by penalizing not only Tehran, but foreign banks, companies, and governments doing business with Iran. Now, this initiative amounts to the ultimatum, which means maintain economic ties with Iran and risk losing access to the United States. So it's an ultimatum that they're giving other countries who are still trading with Iran. And the ultimatum is essentially, you continue working with Iran, then you lose access to the US financial systems and the market. So Treasury Secretary Scott Bessent described the initiative as the largest financial offensive ever directed against any adversary, any country. And so the United States is expecting to broaden a secondary sanctions that will essentially allow Washington to penalize non-American entities conducting business with Iran. So now the potential targets could include purchasers, transporters of Iranian oil, foreign banks processing Iranian transactions, as well as currency exchange and free trade zones. Also, it would include airlines, airports, and shipping registries that are serving Iran, and any tanker operations, transferring networks, as well as front companies and cryptocurrency platforms. So essentially, President Trump's administration's goal is for total financial isolation, which Scott Bassett essentially argues that it could reduce the need for any renewed large-scale military action. So they're withdrawing on the military side, saying that 6 months in, it really hasn't changed anything. And so now it's on targeting the economy of Iran. Now, to that, Iran's rial, which is the Iranian currency, has fallen approximately 2.02 million rials to $1. This is the most record low, and you have inflation and shortages that continue to affect Iranian households. So Iran has warned that cooperation with American sanctions campaign could be treated as an act of war. So really sending out a signal to foreign companies and countries who abide by the US sanctions. They're saying that it's going to be an act of war. Now, Tehran has threatened to prevent any oil from leaving the Persian Gulf if regional countries participate. So meaning you close off the Strait of Hormuz, you close off the El Mandeb Strait, and that affects Saudi Arabia's export from the north and the south, right? From the east and the west to the both water channels. It affects from the Red Sea to the Suez Canal, will affect exports to Europe out of the Strait of Hormuz, and the Red Sea will affect exports to Asia and other markets. So that is what Iran is saying they're going to do in retaliation if any of the GCC countries will participate with this latest rounds of sanctions to isolate Iran completely. Now, Iran has reportedly blacklisted dozens of tankers and threatened them with fines, detentions, and seizures. Now, China is rejecting the sanctions as illegitimate, while the United Arab Emirates has responded has reportedly curtailed trade with Iran to fall in line with the latest American sanctions. When it comes to Pakistan and Oman, will they continue to have diplomatic efforts, including negotiating concerns, and essentially what it means, the concerns when it comes to management of shipping through the Strait of Hormuz. Now, Iran war has reached a near stalemate following months of military operation, as well as the expiration of that ceasefire arrangement, if you recall the MOU that was signed by all parties. Now, Washington says that Iran's military and nuclear capabilities have been severely weakened, but Tehran continues to exercise leverage through the Strait of Hormuz. Now, before the conflicts, roughly 20% of the world's oil did move through the Strait of Hormuz. That's been essentially closed off for 6 months now, and that's affected commercial traffic that's remained substantially below pre-war levels. And it's also contributing to higher shipping, insurance, and energy costs. Now, American gasoline prices have reportedly averaged nationally across the country at 4.11 cents per gallon, so $4.11 a gallon. That's the national average. Western states like California are more above the $6 a gallon mark, and so nearly $1 higher than a year earlier. So massive, and we've talked about how American farmers are having a hard time because of high diesel costs. It's impacting this season when it comes to harvests. So now what economic D-Day means is that this is not just one individual sanction, but it's an effort to use the dominance of the United States dollar financial system and to force other countries to completely stop buying Iranian petroleum, moving Iranian money, providing ships, insurance, or port service, and helping Iran conceal any transactions and supplying goods through third third countries. And so now the foreign bank does not have to operate in the United States to be affected. That's the additional thing, right? So this is going to impact foreign banks as well, not just American banks. But if Washington sanctions it, then the institutions could lose access to the dollar. So let's just say a bank is not going to listen to the American sanctions, then that bank could lose having access to USD, and the American dollar is very important because most trade is done in USD. So that will impact it having access to dollar, American banks, as well as international transactions. So the consequences are supposed to be massive when it comes to major financial institutions that just they cannot afford to go against these sanctions, which then will impact Iran's ability to do anything when it comes to trade. So the global consequences, well, when it comes to Iran, well, you have greater currency depreciation. Already it's depreciated significantly. The average is about 2.02 million reals to 1 USD. Inflation is high, and there's shortage on goods and as well as pressure on ordinary households in Iran, which really puts the pressure on what you see when you see protests take place, right? With civil unrest is when the citizens of a country tell their governments we've had enough. And so these economic sanctions could also put so much pressure on every household that would mobilize what you would see any sort of civil unrest eventually. Perhaps maybe not in this case, knowing that America is leading the campaign and this is just another way of going to war with Iran, not militarily, but now economically. And so when it comes to China, well, Beijing may have to face a choice between protecting trade with Iran because Beijing consumes a majority of Iranian oil, about 40%, and preserving what would be a broader economic relationship with Washington, D.C. And then there's India and other importers. Those companies could withdraw from Iranian transactions to avoid any American penalties they cannot afford. And then you have the Gulf states, right? So the governments cooperating with Washington could face Iranian retaliation, and they're their neighbors, right? They just share the Gulf in between them, or have threat against their shipping against Iran. So really the biggest ones being affected here are also the Gulf countries who are caught in a situation where they cannot do their exports because Iran might cut off the Strait of Hormuz or the El Magdab Strait, and exports will be harder to do, or continue working with Iran and then having to deal with America, which has their military bases in your country, which you depend on the American dollar. So it's a situation that I think no amount of words can really explain how detrimental it is and how critical it is with these decisions. And any way you look, then you got to, crunch the numbers and look at what the devastation numbers will be to the populations of those countries. And then there's the global consumer, that any further disruption in the Strait of Hormuz could increase oil, gasoline, transportation, and food prices. So even Canadians who've been dealing with higher fuel costs for these last 6 months, how much longer is a household supposed to absorb it? How much longer is an American household supposed to absorb gas prices going through the roof, and then that affecting transportation and the cost of goods? And then really the bottom line is the cost of food. And so higher fuel prices even in the United States could intensify public opposition to a war ahead of November midterms because it's just around the corner. So this is what we're looking at when we're looking at this massive D-Day on Iran, but then there's also the repercussions of what's also going to take place when it comes to access to energy markets and the rising prices. We're going to take a quick break and we'll be right back.